Welcome, Ben. Welcome to the show for the Legacy Wealth Podcast. Excited to have you on today. Just to kind of get us started off, we're talking about self-storage as an asset class. Help us get a good understanding of success stories in self-storage.
Sure. Yeah. First of all, thanks for having me, guys.
Of course.
Awesome to be here. Self-storage is a super fun asset class, even though we're just talking about 5 corrugated pieces of metal that you put your stuff into and forget about for 10 years. It's really fun from an investment standpoint. A success story, just to go right to your question, is one in which we can identify a facility that's owned by a mom and pop owner, hasn't raised their rates in 10, 15, 20 years, that we can purchase, and we can produce a very high increase in revenue very, very quickly. So an example of that, we purchased a facility in North Carolina just the end of last year, and rents were 40% under market. So we do what's called ECRIs, existing customer rate increases, and we were able to produce a 38% increase within the first 4 months of ownership, which kind of changes the landscape when you're looking at T3 cap rates, not as important as perhaps like the year 2 pro forma cap rate.
And what are cap rates?
Cap rates, great question. Cap rate is the capitalization rate. That is a ratio of how much net operating income you can achieve against the purchase price of an asset or the value of an asset. So lots of different types of cap rates. You can have your trailing 3-month cap rate against purchase price. You can have your year 2 pro forma cap rate against total project cost. So kind of defining your cap rate is an important thing when you're speaking the language. But yeah, cap rates typically, when you're talking about multifamily or any other asset class that has a longer lease time frame than a multifamily asset, cap rates are usually a T3 or a T12, trailing 3-month or trailing 12 months. But when you're talking about self-storage, if you can increase your revenue by 40% in the first 4 to 6 months of operations, and you can buy off of a T12, that's a home run experience. You have to buy off of a year 2, and the person knows that that's how you should be pricing. Then you're basically paying for the opportunity to put elbow grease into the deal. But
So let's quantify some of that. So home run, right? Big success. What does that look like with this asset class? Is like a 10x, is 10%, is like, give us some context.
Yeah. And I have to remind myself, I'm not in a real estate podcast room right now. We're in a very wide berth. Okay. Yeah. So real estate is still a fixed asset with low return, low risk relative to, say, a venture capital investment into a startup mobile application, right? So totally. We're not going to be 10xing our real estate in a 2-year period. We're not slacking this outcome in 11 months. But we can achieve a 2x in a 5-year period, and that's a great outcome. That's a very good outcome. And sometimes you can get a 3x in a 5 to 8 year hold period. That's a fantastic outcome.
So you come in, you find a self-storage unit, or is it compound? Is that kind of facility?
Now I want to go with compound.
Let's go with compound. Right? We find a compound and we're like, look, you're way undercharging. There's a lot of operational efficiencies to be had here with our expertise. We're going to come in and apply that expertise, and then we're going to make a lot more money off this property and this investment, essentially.
Yep. From an investor standpoint, it's really as simple as that. It's
cool.
Here's the revenue. Here's the expenses. They're already in place. And then we're going to get a little bit of debt on the bottom, or maybe a lot of debt on the bottom of your P&L. And that's going to help leverage our returns. But it's really collect rent, pay for your operating expenses, pay off your debt service. There's your cash flow. And if you can increase your revenue by 40%, you can probably increase your net operating income, your pre-debt service cash flow, by 80%. If your debt service is flat, that's also an 80% increase to your, well, I guess not an 80% increase to your free cash flow, but a greater than 80%, a leveraged 80% increase to your free cash flow.
So as like, I'm putting my prospective investor hat on, and I'm looking at all the different asset classes that I could be investing in. There's, I've heard about funds, I've heard about investing in multifamily, I've heard about mobile home parks, I've heard of, name an asset, right? Why should I be looking at self-storage?
Well, so since you're going to give me a bunch of options inside of real estate, can I make an argument for why real estate first and then dive into?
Sure,
okay,
absolutely.
So right now we're in a very unique time frame where both stocks and bonds suck. It's not a typical thing that's happened in the last 40 to 60 years, right? So I think the average investment into alternative asset classes of the average American is 9% of your portfolio. That includes any type of fixed asset, whether it's real estate or you're investing in ATM machines or gold coins or whatever. 9% is not a lot. And there is modern portfolio theory that suggests that it should be as high as 35%. So when you think about the potential of real estate as an asset class, just by way of future supply and demand for the investment vehicle, there's a lot of opportunity for real estate to grow and for these capitalization rates to compress. And you can think of cap rates as a trading value. If I am earning 5 cents for every dollar of investment today, but tomorrow you have a huge demand for it and you're willing to take it for 4 cents for every dollar of investment, that means that the value goes up. Even though no additional net operating income has been produced, no increase in revenue, no decrease in debt service, just because you have an interest in the asset class that you did not have before, the value of the real estate increases. So if we can anticipate in this unique time frame where stocks and bonds are very unattractive, and there is a much higher interest in other asset classes, alternative asset classes, specifically fixed asset classes, specifically U.S. domestic commercial real estate, we can anticipate a higher value increase. Okay, so that's my argument for real estate as a whole. Right now, diving into why self-storage, all these asset classes are great. I mean, there's a few that we could kind of ping pong back and forth on what is the future going to look like, whether it's office or retail, and the nuances of which work inside of office or which don't. But self-storage is a fundamentally strong asset class, specifically because of unabated American consumerism that is only getting stronger every day. Self-storage does not do well in stable times, but the world is always changing and it's never stable. So whether it's a great time, whether it's a booming economy, it's the 1920s all over again, or we have the Great Recession happening, that's volatility, and self-storage performs well in volatility. Death, divorce, downsizing, promotions, upsizing, getting a new house, a new kid, whatever it might be, all of these life events typically involve some type of storage. 1 in 10 households used to have a storage unit. It's now 1 in 9 households, and that transition happened over a 3-year period.
So let me break that down a little bit, just to simplify it. So look, Americans in general, we like to buy lots of stuff, and we need a place to put that stuff. And in times of change, let's say we're downgrading our house or we're upgrading our house, right? Or you have some sort of other dynamic change going on. Most people utilize a storage unit to store their extra stuff or as they're kind of in transition. And that provides a really good opportunity for the asset class.
It does. And then you kind of, for guys like you who are living in what I've just recently learned is some like smash up of a hotel and apartment, you kind of live a little bit more of a potentially transient, I'm going to call slightly futuristic lifestyle, and you've adopted some minimalism or essentialism into how you live. But there is a the majority of the average American not only uses storage for these transition periods, but finds themselves extending that transition period into perpetuity. Yeah. So a very large swath of our tenant base has had their units for 3, 5, 10, 20 years. Yeah. And they just, and even though the math doesn't make sense, they might be spending $45,000 on this unit over a 20-year period. They would not pay $45,000 for the contents of that unit, but they will continue to pay the $100 and $150 a month check every month.
So as an investor, and I know that your company, your fund has multiple different options in the space, but let's talk about the asset class in general.
Okay.
We'll get to yours later on in the show. What am I investing for? Am I investing as an investor for cash flow? Am I investing for equity growth? What hat do I have on? What is the problem that I'm trying to solve when I'm investing in this asset class?
And just to frame the question, inside of real estate, right? Not inside of the entire landscape of investments. Is that the question?
No, I would say as in the landscape of investments.
Okay, so then I'm going to give you 2 answers again, if that's all right. So why invest in real estate as part of your overall portfolio? Real estate is the only asset class that I think that has had a increase in value over the last 100 years, almost every single year. And over every 10-year cycle has always increased in value in a way that's outperformed the S&P 500. 90% of all millionaires hold real estate, and every single billionaire holds a massive amount of real estate. Real estate is the most dependable way to increase your allocation of net worth relative to all of society. It is the most dependable way. So real estate is this collateralized fixed asset, this tangible thing that is very difficult to have vanish, like perhaps some other investments you might make, perhaps something speculative, like crypto, which has an outsized return if you do it right, and an outsized downside if you do it wrong. Real estate has significantly less volatility and very dependable increases to its value. Because of the nature of its tangible asset in the physical world, there is a limitation on being able to produce more of it. You can create more real estate. You can't create more land, but it takes time and cost and energy to create more real estate. There's always another stock. There's always another coin that you can create. And the value of what you have today can change overnight. So that's why I'd say real estate. It's a great complement to financial instruments. If you do not have fixed assets complementing your financial instruments in your portfolio, you're not likely to outperform the best in your peer group. So why self-storage? All, for the most part, all asset classes in commercial real estate do very well. Self-storage isn't much different than the other asset class. There's always oscillating supply and demand for the space markets. Like, what do you use industrial space for versus hospital space versus retail space? So there's always oscillating supply and demand. The reason that you do storage is because you learned about real estate, you decided you wanted to invest, you put a bunch of money into multifamily because that's what the majority of commercial real estate is. And then you realized, oh, I'm overexposed in multifamily. There's other things like storage or industrial or office or retail. And so perhaps you want to hedge against your multifamily without taking it outside of the commercial real estate class. Self-storage has outperformed over the last 25 years. The REITs, I should say, of self-storage have outperformed every other composite of REITs in commercial real estate of any other asset type. That just because that's happened doesn't mean it will continue to happen. But the reason to do it is really to diversify away from multifamily.
That's cool. It's super helpful.
Yeah. Okay. Understood. So to repeat back to make sure I'm understanding you correctly, it's why self-storage is more of because I want diversification in all types of real estate that perform generally well.
That's my take. I mean, I'm a passive investor too. I don't put it all into storage. So, right?
Yeah, totally.
Sure.
Yeah, I think all of us, right? Like all of us invest in multiple different kinds of asset classes. I'm invested in crypto and in single family homes and in multifamily and developments. And it's just a great diversification strategy. So I get that.
I'll also add one more thing that if you look at the performance of self-storage kind of layered over GDP growth, and you can kind of see those down spikes in recession times, you'll see that self-storage stays flat, if not sometimes improving. So it's a very I'm not going to say proof, but recession resistant asset class.
When it's probably really hard just in general for someone to switch storage units, right? So it's like you have all your stuff in there and it's like, how much effort does it take to move it over to another storage unit? So I imagine you guys have, tell me if I'm wrong, but you have really long lifetime values of your customers.
Well, when you know the address, the mailing address of your customer, and it's in another state than where the tenant, the unit is, that's super helpful to know. And that is true. I mean, when we first met, I was living in New York and I had a unit, and it was very difficult after I moved to Colorado to kind of get around to going back. I mean, the storage facility compound made $1,000 off of me, more than I anticipated, just because of how hard it was to get back and fit that into my life. And that's before I was married with kids. So, the majority of our tenant base are those that haven't gotten around to doing the emotional work to separating themselves from the items in that unit. And it's just more convenient to say, I'm going to let these things continue to happen. If somebody could show up on television like an evangelist and all of a sudden get the average American to get over their attachment to things, the self-storage industry would be in trouble.
Sure. That's probably not going to happen.
Yeah.
Probably going to get the opposite.
Yeah.
So tell us a little bit about starting off in the asset class. How did you kind of get your start?
Fell into it. So was into real estate, had syndicated my first multifamily building, and did not enjoy participating in the residential sector. Knew I wanted to do something different. So when I moved out here, I started a conference called the Best Ever Conference for commercial real estate mid-market syndicators, operators, and investors. And by way of doing that, I met a series of potential partners that were kind of starting off doing something new. and got married up with a duo that had previously been flipping brownstones in Washington, D.C., doing pop tops and dig outs. They were doing very sophisticated.
What are brownstones?
Brownstones, like a townhome in Washington, D.C., like a row home.
Okay.
That might have been a single unit. They would do a pop top, add another story, or a dig out, like turn the basement into a unit, and then turn one unit basically into 3 or 4 condos, condoize it, and sell the units off. And so they were doing pretty cool stuff there. They were good at construction management. I had acquired 50 single family, multifamily units. I was good at the acquisitions and the underwriting and the cash flowing investment play. But we were both squeezed out of our respective strategies. So we did a decision-making process. It's actually a military decision-making process, came from the Army branch of the military. Our CEO, Scott Lewis, my partner, is a military guy, and he's brought a lot of that education into our organization. And through that process, we used evaluation criteria, which includes ease of operation, ease of maintenance, and ease of eviction, to determine which asset class do we want to focus our energy in. And there was a couple of options left, and we looked at the historical performance, explained that historical performance, and extrapolated out if it will continue to have that performance. Self-storage was the clear winner. And it, at the time, was still very, very fragmented. 75% of all facilities were mom and pop owned. So there was opportunity to continue to enter only 5 at the time publicly traded REITs. So there was just opportunity to enter the space.
Interesting. That's super fascinating.
So something I'm hearing maybe in between the lines is that self-storage is an opportunity now with buying up these mom and pops. But at some point, all the mom and pops will have been bought up.
That is true. It will be an institutionalized asset class. Yeah.
Yeah. So the time to get into this, at least with your strategy, is now.
I think so. The earlier you get in on something that works, the better, right?
Right.
So yeah, it was great in 2016. It's still great today. I think that the supply and demand really works in our favor in the long term. There's some Fed produced pressures that are maybe causing some short-term hiccups, but in the long term, cost of construction has doubled. Cost of interest rates on construction loans are up 70%. Smash those two things together, and there is a lot less territory in the United States where it makes sense to build one, which means if you're in secondary and tertiary markets, you've got a moat around your business plan for a couple of years.
Describe primary, secondary, and tertiary markets for...
Yeah. Very, very, very fuzzy definitions that anybody can define however they'd like.
Yeah, sure.
Some common uses of primary are either the top 25 or top 50 MSAs. That would include places like Denver, Seattle,
MSAs,
metropolitan statistical areas. Yeah, you can think of cities. So New York, LA, Atlanta, DC, San Francisco, Chicago, Cleveland, Denver, Seattle, Houston, Dallas, all the big ones. It's top 50 or top 50 in population size. Secondary would either be maybe a bedroom community outside of one of those primary MSAs. Think like Forney, Texas, which is a solid 15 minutes outside of downtown Dallas. 37% population growth, 4 years running, something like that on average. So that would be kind of a secondary market, or a secondary city that falls outside of that top 25 or top 50. Think like, I don't know,
Fort Myers, Naples.
Yeah, Fort
Miami
Collins, and
Tampa.
Yeah, exactly. Yeah. Thank you. Yeah, Fort Myers is a great one. And then tertiary, you're kind of getting into those towns where you might not know the name if you're not from the state. So think Texarkana, Texas, right? Corsicana, Texas, right?
Sure.
So 30,000 people in town, 60,000 people in the MSA. That's still a solid population, but if you're not from Texas or you haven't watched that Netflix special about that cheerleading squad, you don't know Corsicana, Texas,
Sure.
right? Or if you're like obsessed with fruitcake, Corsicana, Texas is the international home of the fruitcake. We own there. That's why I know that.
Random knowledge drops.
Yeah. And then you got rural, which is like all the stuff where, Spicewood, Texas, population 600 right outside a lake, that kind of,
okay.
That's your rural.
Super helpful.
Yeah.
One of the things we're big on, obviously, at the Legacy Wealth Podcast is, look, we think that a lot of people, they hear about an asset class and they immediately think, maybe I should go do that. And I think the problem with that there's a lot of unknown unknowns. So let me ask you, Ben, what did it take for you to become an expert in the space? And then a subsequent question to that we can kind of dovetail onto is, when you think about somebody that's just kind of dabbling in this space, right? Or maybe doing it part-time, they have a full-time job. Contrast their day with your day. Basically, tell us what you're doing as an expert.
Yeah. So I'll answer the first question that you asked, which is I think to be an expert in anything, relative term. I always kind of, am I an expert? Who knows? I'm still learning, right?
Right.
I think to be an expert in anything, it's like, could you perform that concerto on the piano in front of a crowd of 10,000 people? You need to use your entire life. You need to dedicate your entire working hours to becoming excellent at that. And so if I think if someone is considering, I want to invest in self-storage and I want to be a active operator, if you want to do it at the scale that our fund is attempting to do it at, it needs to be your entire life. Trying to do it on the side, it is an operation. It is not a passive investment, and you will run into difficulty. But what is my typical day? So is this the part where we kind of start diving into Spartan?
Almost.
Yeah, all right. Almost. All right.
Almost.
I mean, my typical day, we're looking for deals, but we're also running a business, right? So it's not just my role is to identify the investments, optimize them, and then identify the appropriate time to dispose of them. So I'm spending my time doing that. We're looking at every single listed deal. The interesting thing about the self-storage space is that there's very, very few brokers that have any meaningful volume. There are maybe a half dozen brokerage groups that account for 70 to 80% of the transaction volume in the storage space. So that is something that's unique compared to other commercial real estate asset classes where you kind of have one brokerage group per city for that asset class. So you need to build those relationships, maintain those relationships. It's a very, very small, incestuous industry. So you need to be knowledgeable and careful about who you work with and who you don't work with and what happens and what you say after you work with certain people. But we're kind of at a transition point in our organization where we're going from being investors to being business owners. And so we are kind of separating our ownership group from our storage investment platform. So more time of my day, just to answer your question in a way that probably doesn't get the outcome for this podcast, is being spent on building leaders that can own certain functions of our operation and ensure that they can perpetuate the right outcomes in our investments without as much involvement from me or my partners, so that we can go do the next thing that we want to do.
So what I'm hearing is this is a very active business, even whether you have one self-storage facility or hundreds.
Super active.
And so are you looking at like 10 deals a day? Are you looking at like 500 deals a year? Are you spending like a week doing due diligence on one property? Like, are you 20 days out of the year, are you like visiting facility? Like what does that look like?
Yeah. So we look at over, let's see, it works out to be about two deals per day. And most of those deals are multiple facilities.
Wow. So you guys look at 2 deals per day.
Yeah.
And so maybe another way to, like an alternative way to frame kind of this portion of the podcast is where does the margin come from, right? What is the difference between the average returns versus the returns you're able to gain? So a couple examples would be, what is the benefit of scale and what is the benefit in you guys being able to look at so many deals? And like, let's quantify that, or at least frame it a little bit.
Yeah. Okay. So, I think to answer your question, I'll start by, talking about what the activity looks like. Yeah. So two deals per day. We spend about 2 days doing due diligence on a deal that we really want to, doing feasibility on a deal that we really want to take down. Due diligence, we have a 700-point due diligence checklist that we go through, that we have an entire team dedicated to, that we can do as many as 20 assets at one time before we start feeling the burn. We have a massive operations team that includes marketing, revenue management, field operations, customer success, call center, website, transitions, and then there's on-site staff, district managers, regional managers, and then like a VP of field operations. So very, very large operations team that all needs to be managed, all needs to be communicating with each other. So then you kind of get into the business operations of like what's our file sharing system and our communication paths, and what's our meeting cadence and all that stuff. What are our KPIs? What does a day of success look like versus a failed day? So yeah, very active operation, and all of that is how we're able to create the margins at scale.
Sure.
If we can buy one asset, but we spend all of our personal time making that asset successful by showing up and cutting the branches off the trees and dialing, talking to the customer on the phone and inputting their information into the system and fixing the gate and calling the security company when the alarm goes off, all of that stuff, I would be acting like a mom and pop operator. I would not be valuing my time in the P&L. And my time does have value because if somebody were to purchase the asset from me, it would be replaced with a third-party manager that would be charging for that time for the next owner. So we are not disillusioned by the reality that our time cannot be dedicated to operating the facility. Okay, so now our time is one level up. Our time is now dedicated into investing in the assets, identifying which ones we should purchase, calling the banks, negotiating the terms, identifying our capital sources, managing the third party or managing the on-site management team. But that time also has a cost, right? And so that needs to also be underwritten into our OpCo. So, all right, let's take us one more level up. Right. And now I need to find people that can generate the investments. I need to find people that can manage the operations team. And every time I do that, it requires more facilities to finance that operation. But every additional team member takes a smaller chunk per square foot of our NOI than the previous team member did, in theory. So as long as we're doing that and our NOI continues to scale, while, our net operating income per square foot, continues to scale, while our headcount costs per square foot continue to come down with each incremental headcount, we're moving in the right direction.
So let me do a layman's translation of all that. It's a team sport.
Yeah.
And it's a full-time sport.
Yeah, there it is. Team sport, full-time sport. The more you get, the more money you can make per unit.
And that's what it really takes. You know, when someone says, "Oh, I want to enter that asset class," the returns that they have in their mind that are market, which I think you mentioned 2x in 5 years. It's that if you have a team, and that's if everybody's full-time.
Yeah, and don't get me wrong, you can hustle it together. I've seen some groups do that.
Sure. But I'm sure you've seen a lot of examples where they can't.
I've seen the examples where they can, and it takes 2 generations. Yeah. And our team has done it in 4 years.
Yeah.
So I think that's the difference.
Yeah, impressive. Well, it makes sense. I mean, anytime you can dedicate to your art, you're going to have better returns.
I appreciate that.
Of course.
Yeah. So, do you want to continue on this this expert thread?
Well, just real quick, what we haven't touched on is the risks in the space. So there's always risks, right, in any asset class, right? Even if it's low risk. What are those?
Yeah. So the first one that comes to mind is what is the collateral that you're actually buying? So I think
collateral.
Collateral is what is the physical, tangible thing? The walls, the roof, the windows, the doors. It's referred to as collateral because when you get a loan from a bank or from anyone, they say, okay, I'm going to hold on to this car until you pay me back, or I'm going to hold on to your house until you pay me back. That whatever that thing is that they are assigning value to on behalf of the loan that they will take if you do not repay the loan, that is the collateral. So the collateral in self-storage is a bunch of corrugated metal, which is very different than a building like this one where you can live and work and play in. If everybody here were to vacate because the current use is no longer valuable to society, it would be a little bit easier to restructure the internal space for another purpose without completely demolishing the building. So the collateral has a higher value to a lender, whereas in storage, the collateral, drive up, roll up, self-storage, one story asset, just doesn't have another purpose.
So collateral is higher if it has multiple uses.
Yeah.
So for instance, this was an apartment building. Now we've converted into commercial shops or something like that. But you're saying with storage, which obviously makes sense, the way it's built, the way the structure exists, it pretty much can only be used for storage.
Yep. Which is why up until about 10, 12 years ago, you did not find a lot of loans in storage that mirrored those of other major food groups in commercial real estate, like hospitality, retail, office, industrial, and multifamily. But that's changed in the last 10 years. For whatever reason, the lending community does not seem to care about the collateral. And those loans look almost the exact same, if not better, for self-storage because the demand is so high to invest in self-storage. So that's the first thing that comes to mind. And it's not even with respect to us, the investor, and it's not even anything that the person taking on the risk cares about. Which maybe is an indication of how much risk there actually is.
But maybe what you're saying is the risk is potentially that trend you saw 10 years ago and before could maybe come back like in an unpredictable future.
If Mr. Evangelist shows up on TV and somehow solves all of our collective insecurities and allows us to detach ourselves from our stuff and creates, 50% higher occupancy, there would be no other use for the building, and we would.
He sounds like an amazing guy.
Yeah, I mean, something that I may be registering here is also you maybe buy an asset and you miscalculate how much you're going to raise rents by, or your expenses are slightly higher, but other than, or maybe like a hurricane comes through and demolishes your building, but you have insurance for that.
You have insurance for that, yeah.
Or maybe a city's just not as popular as it was.
Yeah,
right?
the population is declining in the city.
Right. So like everyone's moving to Austin. Oh, like suddenly people don't want to live in Austin anymore.
Yeah, but I mean, here's the thing. You've got census data, which sucks, but then you've got all this other data. I mean, we've got so much. I mean, you can measure the number of U-Hauls that are going from LA to Boise, Idaho and back. And you can see that publicly because you can look at what's the cost to take a U-Haul from LA to Boise or to take it from Boise to LA. The cost in one direction from LA to Boise is $2,500. The cost in the other direction is $400. That's an indication that there is not enough U-Hauls to get people to Boise with their stuff, right? So you can predict population growth with pretty high accuracy because of all of the data that our species has been able to collect and the infrastructure of data warehousing that we've been able to produce. You can predict income growth, you can predict job growth, you can predict rooftop growth. So that we don't really see that as a risk so much when it comes to the demographics. I think what there are risks are, and when you're investing in any piece of real estate in any town, there's one asset that we own in a place called Fort Valley, Georgia, and the economy there is basically driven by one company, Bluebird, which makes buses, and they did great during COVID. Don't know why, but now they're investing in electric vehicles. So we didn't really underwrite Fort Valley, Georgia. We went and learned everything we could about the Bluebird Corporation and underwrote that corporation because that finances that economy and it finances job growth and population growth and income growth.
And for our listeners, underwrite?
Underwrite means to evaluate the thing that you are trying to make money off of financially.
Okay.
A financial evaluation. Yeah.
So I think this kind of dovetails into the next portion where like we talk about the secret sauce of your fund. So you're talking about all of these different things that you analyze. Can you maybe go into more detail of what makes you guys different? What's your sauce? What's your process? What's your strategy?
Yeah. So I think the perspective matters. Who's the avatar that's looking in on what makes us different? When we talk to our peer group, we raise capital from retail investors in a way that nobody else does. Retail investors being those who are accredited investors with $1 million net worth or more, excluding their personal residence, or have a $200,000 income as an individual or $300,000 income joint household. And those accredited investors, we have over 9,000 of them in our network. About 10% of them are activated, a little over 10%. And they have made over 2,000 placements with us. And consequently, we've been able to raise $250 million of capital without ever going to Wall Street, without ever going to a major institution that can control us. That freedom of movement gives us flexibility. That flexibility allows us to take on different debt. It allows us to take on different complements of storage. For example, we bought 2 assets in Longview, Texas, and then one came up just a mile down the road, and it was 4% occupied. Now, it might sound terrible to you, but it was a 62,000 square foot facility being sold for $1.6 million. What is that? That's less than $30 a square foot. Meanwhile, Longview, Texas is trading for $80 a square foot. All we have to do is get that thing occupied, which you can do in a couple of months, but no bank would lend on it. So by way of having that retail capital, we have the flexibility to say, that's a good business plan. We don't have to fit somebody else's box that doesn't pay attention because $2 million doesn't matter to them. We can go buy that, complement it with our existing storage, and fill it up super quickly and make money for everyone. So from that perspective, our retail capital is a unique selling proposition. From the retail investor's perspective, I think what makes us different, and I've had 5 or 6 years to ponder this because there isn't all that much difference from a fund. You get money, you buy real estate, you do your best to operate it well, you get the right note on it. But how do you make sure that that outcome is going to be great? Is it the deal? Is it the market? I think more than anything, it's the team. And so how do you evaluate a team? And the team's important because a great operator can make a terrible deal be okay. But a bad operator, a negligent operator, can take a great deal and turn it upside down, take all the money, run to Mexico, right? So how do you evaluate a team? I think for us, our ability to infuse culture into our organization, develop clear strategies that our team revolves around, and focus on developing leadership skills and leadership potential into our entire organization. That focus allows us to be very malleable and to kind of row together and align ourselves into producing the right outcome. So even if we have a hiccup in a deal, we have 5 years to make it work. The first year doesn't go according to plan. All right, we've got the flexibility, we've got the network, we've got the alignment internally, we've got the culture, we've got the team that says every week, we believe in growth, we believe in respect, we believe in integrity, we believe in tenacity, we believe in transparency, and we're going to use those values as our guardrails to produce the best possible outcome for our winning aspiration and our mission statement. And so us being able to clearly communicate that not only to our team, but to our investors, I think it sounds like this soft phooey stuff, but it really has made a huge difference.
Yeah, I mean, so something we talk about pretty often, Mike and I, is that you should be focused on being an incredible operator in your active income business, and then you should go find experts to invest in the other asset classes. And so, the question that's coming up in my mind, putting my perspective LP hat on, is, okay, I'm hearing this talk about team. What are questions? What goes into my due diligence process that I would ask you as a prospective fund that I would invest into versus another one that would help me understand that you have this special sauce that maybe another fund does not?
So I'm going to ask this to you as personally.
Sure, yeah,
right.
Let's do it.
You've hired people.
Yeah,
you've hired people. Okay, you've worked with people, right?
Yeah, hundreds.
So okay, so what are the best questions to ask someone that you're going to work with that maybe is going to take some of the work off of your plate? Because that work is your baby, right? That's work that you care about. And I think the kind of the leadership heuristic is if somebody can do something at least 80% as well as you can, but can give you that time back, and you can trust their character, that they're going to come and tell you when they don't know something, when they've done something wrong, they've made a mistake, and they're going to own up to it, and they're going to do everything they can to fix it. That's kind of what you're looking for when you hire someone, right? We're just employees for hire, right? I mean, we're taking your money, and it's your hard-worked cash, hard-earned cash that is going to define your ability to retire. It's going to define your children's ability to go to the right school, whatever it might be. Define like your next home, and you are trading time for control. Right? You are giving up control in exchange for time, and allowing us to do the best job that we can to produce a return, to produce that outcome with that cash that you'd like. So if you've ever hired someone, if you've ever worked with someone, even if you just interviewed someone for another team, and you are looking for those soft skills, you are looking for that glimmer in their eye that tells you that they're not a sociopath, right? That's kind of what you're looking for in due diligence. And how do you write that down on a list and say, show me your track record? Right? That's important. Don't get me wrong. Show me a track record of a bunch of 6% IRRs and negative 10% IRRs and tell me that's a good dude. I'll agree with both of those things. Good dude, good gal, can't produce an IRR, internal rate of return, which is a metric for a return. I would not go with that. But if I'm going to rank those two things, track record versus the character of the person and their ability to produce a great outcome despite the challenges and obstacles set before them that will come when things are not just easy, I'm going to rank the character of the person higher than the track record. And I'm going to rank the team first. I'm going to rank the investment thesis, the intelligence of that team second. I'm going to rank the market third, and then I'm going to look at the deal. The deal is so far at the bottom. I'm not going to do due diligence on somebody else's deal. I don't know what makes a good deal work outside of self-storage. And I'm not going to evaluate the survey and the title and the zoning and the physical report. I might check out the underwriting just because that's a skill set that I have. I'll open up their Excel model and say, all right, what's their expense to gross income ratio? What's the debt service coverage? Just to make sure there's no errors in the math, and like, do these heuristics kind of comport with my expectations? And if not, maybe I'll ask a question or two. But it really comes down to, have I met you in person before, and have we talked about your obstacles and how you overcame them?
So what are the questions you wish more potential LPs or LPs asked you?
How did you overcome a hard thing? Tell me a time when. Tell me about a situation when. Because if they ask that question in advance and that's what's important to them, when something hard happens, which we've had some things hard happen, they don't come saying you should refund all the fees, which are the fees that we use to finance the team that ensures a great outcome. You should sell everything at a low. You want us to sell everything at the low point. You should, refinance or you should, give yourself, 9 lashings for your mistakes or whatever. Like I would prefer to have investors that, read us as having the best possible intent, that box ourselves in to making sure we produce the best possible intent by looking at our KPIs, by looking at the outcomes and compensation and incentives of our team to ensure that we're getting the best outcome, as opposed to focusing on the details of the deal today over a 1 month or 3 month time frame out of the entire 5-year target hold.
Makes sense. Yeah, I mean, I like that because it's approachable no matter how much you know about an asset class. And obviously, when you're doing diligence, as a retail investor on an asset class, the whole idea you're doing it is because you want to hire someone to do this for you.
Mm-hmm.
So you don't know the right questions to ask.
Yep.
So it's, okay, let's focus on the character. Let's focus on how I would want the investment manager to respond to me, to honor my time, and to be truthful and transparent with me.
Mm-hmm.
Now there is a delicate balance there, right? Because I've met many retail investor that invest in a deal because their friend invested in a deal or whatnot. Right?
Well, I would just never do that
Yeah,
as well,
yeah,
right?
yeah,
So like,
yeah.
I have friends who are like, "Oh, should I invest in Spartan?" I'm like, "If you want to, but I'm not going to try to convince you because I value this friendship more than your $50,000."
Right. Yeah. Okay, cool. Is there anything that I would kind of like to go down that rabbit hole? Just that one question of, tell us about a time where shit went sideways.
Yeah. The best example that I have that's full cycle is something that I personally did outside of Spartan.
And when you say full
interest?
cycle, yeah, you can say full. And then when you say full cycle, what do you mean?
Full cycle meaning I bought it, I operated it, I sold it, winded down the company that the asset was held under. That's full cycle. The whole thing, right? So a lot of the stuff that has gone sideways at Spartan has already fixed itself and has produced a potentially great outcome. Like it's kind of floating now, or we're in the middle of it. And talking about it now doesn't give us the opportunity. I mean, I'm happy to, but doesn't give us the opportunity to showcase what the endpoint's going to look like.
Yeah.
So the stuff that went, the one that I took full cycle that didn't go according to plan was my very first syndicated asset in multifamily. It was the experience that made me realize I don't want to do residential personally because the investment thesis that I came up with requires me to separate people from their livelihoods, their homes, at a very high rate, not just because they're acting terribly, but just because they had a bad month or bad 2 months. And
so a high eviction rate.
Yeah. And so that wasn't my favorite. I did it because I needed to do the investments, but I probably overpaid. First investment, very exuberant. When you're kind of getting in the space, you're trying to be active for the first time.
Mm-hmm.
You just like all this time. I just want to get a deal done. I want to get that sponsorship fee. So you kind of go in and you can make any deal work on paper, right? If you're an Excel junkie, you can figure out how to make that look all right. So I probably overpaid somewhere between like 6 to 8% on the price. And then, and the reason I did that is because I took guidance from people who were incentivized to get me to buy the thing, the broker, the property manager who was going to get the business on revenue, regardless of the net operating income, the banker. So instead of getting outside, non-incentivized, unbiased counsel, and then that property manager just did not do what they said they were going to do. They said, these are the rents you should be able to get. They never even attempted to get to those rents and struggled with rents 10% below that. So way oversold. And I had planned on making distributions almost like right out of the gate, like month one. And
Distributions,
a monthly or quarterly check of a return for your investment. A distribution is
the money coming back.
The money coming back.
That's why I'm doing this.
Yep.
Doing this to get some money on the way back.
That's your mailbox money.
All right.
So I think I did it for 3 or 4 months, and then I was like, oh, I'm bleeding. I'm going to cut it off. So I cut it off. Our boiler broke, our HVAC broke, our roof started leaking. Even though I had the PCRs that said, yeah, you don't need to do any of these. Maybe you'll need to do one of them in the next 5 years. They all smashed out in the first 18 months.
Property compliance reports?
Property condition report, excuse me. Property condition report. Did I say PCR?
Yeah.
Yeah, excuse me. Property condition report. A report that's done by an inspector who is licensed to tell you if your piece of real estate is more messed up than it appears to be from the eye of a layman.
Sure.
Yeah.
And look, I want to bring this full circle back to what we were discussing kind of in the other part of the podcast, which is these are the things you've had to learn, right?
Yeah.
This is how you've become an expert.
This is the
So
scar tissue.
when you enter into an asset class, I think you're thinking, okay, I'm going to buy a property. I'm going to start making some money and that's going to be awesome. And you're not thinking of all the things you have to deal with because you don't know. You don't know of all the problems and all the problem solving that you have to do and all the kind of like finagling with expectations and what actually happens, right? And so I just want to highlight that. I mean, what you're really demonstrating to the listeners is, look, you have to be prepared to have a game plan for all these different things that may not even be on your radar.
Two quotes that I love to mash up, I think, is the Eisenhower quote. Planning is essential and plans are worthless. And then that Tyson quote, everybody's got a plan until you got punched in the face.
I'll throw one more in there that I love
Yeah.
because I think it's actually relevant to what you talked about, the thing that went wrong. And it's the things that, the things that break you make you. And it's like those learnings are really why you're able to operate with such efficiency today is because you went through that.
Yeah. So, I mean, fast forward 3 years later, I had to break up that it was 6 parcels. I had to break it up into 3 different transactions and sell them piecemeal by like finagling, getting this tenant to move into this unit, even though she was probably happy where she was kind of interested in maybe going up to the 2-bedroom. And so we get an extra couple $100 a month out of that. And I financed the entire move to make it happen. Right. So things like that to just kind of eke out just a little bit more to get my number that I waited a year for, just so I could get a 7% annualized return for my investors, which, sounds like a decent S&P 500 thing, but is a terrible return. It's not great.
Right.
And I worked for free for 3 years, basically. I mean, all the upside went to them. At the exact same time that was happening, I had 24 single family houses that had gone well, and I was continuing to buy them. And I had them going so well, I'd actually paid a couple off free and clear, but I was watching other people making $50,000 in 2 months on a flip. And I crowdsourced about $250,000 to do a couple of flips, tried 2 out. Tried to do a model where I didn't have to spend that much time. I tried to outsource a lot of the work. And the first 2 went well, kind of some false positives of reinforcement. Like, all right, I'm going to put more money in. Dumped $250,000, did 5 flips at the same time. Every single one of them lost money. I did not just make a return. I lost the entire principal of that fund, plus additional funds from myself. But it was an equity investment. So in theory, all of my investors were kind of out of luck. But that's the moment where I'm like, all right, I'm in my 20s. I've got a long runway ahead of me here. The people who've invested in me today are going to be the foundation of who invests in me and my team and my brain in the future. So I remortgaged those houses that I had paid off free and clear, and I made sure everybody got paid back 8.5%.
And what does the fund target? What does your fund target?
So that was a flip fund. This was 10 years ago. But Spartan Investment Group has 3 funds. One of them is a private debt fund. It finances acquisitions or it finances expansions. We don't take a margin on that fund. It just gives us flexible capital. The other 2 funds are an income fund and a growth fund. The income fund targets cash flowing assets that are higher stability. It's going to be a lower overall internal rate of return or a lower return on your investment, but it's going to be lower risk because you've got occupied, stabilized assets. Our growth fund is targeting development opportunities, so parcels that are ready to be built ground up, and certificate of occupancy deals, meaning those that were built by others, a merchant builder, who are now selling them empty at the moment in time that they are allowed to open for business, and handing them over to us and taking on the lease up risk. Both of those types of risks, construction risk and lease up risk, is more risk than owning a stabilized storage facility. So the growth fund has a higher return to compensate for that risk.
So are we talking 5% IRR? Are we talking 10, 15, 20? Like what? Give us, and then like lockup period.
Yeah. So internal rate of return is a time weighted return. And so it gets a little bit funky. I'm going to give kind of a simple interest return range, if that's all right.
Sure.
So an annualized total return for our income fund ranges from 14 to 18%. And an annualized total return for our growth fund ranges from 20 to 25%.
So if I invest $100,000 into your growth fund.
Mhm.
4
to 5 years later, it'll double.
Okay, because 20% times 5 years is
Targeted.
Yeah, targeted.
It will double.
Yeah,
Should double.
Yes.
Yeah.
And so, why would I choose? You mentioned 3 different funds. Why would I choose one fund over another?
Yeah, your risk profile. So if you want to be first on the stack, meaning you get paid before the investors in our other 2 funds, which is lower risk. You don't have to have as much returns to make sure that those distributions, those monthly checks are going out. If you don't want to be exposed to lease up risk, construction risk, or even ownership risk, you would participate in the debt fund. You are going to get paid first, basically, across our capital stack. And it is going to be secured by personal notes and fractional deeds of trust. So it's just a much, much lower return. And it's a very consistent 7, 8, 9% return. There's no upside though. So it's a significantly lower return.
Same time frame, 5 years.
Same time frame, 5 years. Yeah. Can be shorter.
Sure.
Can be longer. If you're a yield chaser, meaning you want just like the most return on your money, you don't need to live on that money. You don't need it back right away. You're okay with it being locked up. You don't need to get a check every month. You're okay to just get one big check 5 years from now. That's double what you gave us today, or 4 years from now. Then you would be a great candidate for the growth fund because you're going to get the biggest return. You are going to take on more risk, which is when, understanding us and getting beat up in development and construction and how do we compensate for those things? What is the scar tissue we have from development and construction? Learning about that is probably the most important due diligence you can do. What are our war stories in development? Because we have some really cool ones. But if you're that yield chaser, you want to be in the growth fund. And if you're somewhere in between where, I can get 4% at the bank, I can get 7, 8%, giving it to my family members or whatever. I want something that's a double-digit return. Construction development kind of freaks me out, but the idea of a stabilized asset that's already producing cash flow, that sounds like the kind of risk that I can be okay with. And I'm going to get a mid-teens return. That's then the income fund is for you.
Yeah, that's awesome. Well, Ben, thanks so much for having us on. This was amazing.
Yeah, thank you guys for having me.
Yeah, man. Thanks again.
All right.